they can improve their odds of getting funding. So on the panel, we have Cindy Padnos, the co-founder and managing director of Illuminate Ventures. She was named one of the most influential women in technology by Fast Company. We have Nat Goldhaber, and he's the co-founder and managing director of Claremont Creek Ventures, investing in early and seed stage companies in healthcare and energy. We've got Selke, a founder and managing director of BetterVC, an early stage venture capital fund focused on high growth tech companies and social and environmental focus. And Ruben Hernandez, the co-founder and CEO of DevLabs, which is an investor and incubator in entrepreneurs in US, Latin America, and Caribbean. So, to get this started, I'd like to talk about the big change in the sentiment in venture capital right now and what the main difference is for entrepreneurs trying to raise money. So Ruben, you want to start?
Oh, great. Sure. Well, I think we're a good example. We started, we have a fund here in Oakland, which is our own money. We bootstrap our own VC fund essentially here in the Valley. But we were able to raise money outside of the US and create a fund down in Chile. For the past 3 years we've been working down there. And it was just the industry was just too crazy here to do anything at the stage that we were in, an early stage. Valuations were too high. Expectations from entrepreneurs were way too unrealistic, as when it comes to valuation. So we stayed out of the U.S. for 3.5 years. Now we're starting to come back, and the reason why we're coming back is because now we can raise money here from LPs. We're starting to raise money in our new fund for California. So it's a California fund that we're starting to raise money for, just because things are more realistic and they've come down to earth. So for us, it's really exciting. It's time for us to kind of raise money quickly so that we can start getting into conversations with entrepreneurs fast.
Wes?
Sure. I think there's a lot to be said about it, and we'll probably cover it on this panel. But I mean, we're definitely. I'm not going to say anything that people don't already know. We're in a slowdown in the VC space. I think it's a healthy correction. I mean, certainly from an investor perspective, some of the points that David touched on in the last presentation, I think are really accurate. And a positive thing, particularly if you're on the funding side. I mean, I think the sort of coming back to earth of the expectations around valuation, a lot of that stuff has just gotten a lot healthier, where maybe a year ago we were seeing seed stage deals priced at $7 million that are now being priced at more like $4 or $5 million. So priced more reasonably and more appropriately, in my opinion, and kind of coming back down from the stratosphere. It doesn't feel like it's been any sort of crash landing, and you can see it in the numbers. Deals are still getting done. I think high quality deals are continuing to get backed, and I do think this whole sort of milestone based investing is a really big thing that's going on, where we're essentially seeing like Series A being the fourth round the fourth funding round that a company raises. 10 years ago, you start a business and raise a Series A round, and these days it's about the fourth round that gets raised. You have your friends and family accelerator round, you have your pre-seed round, then you have your seed round, then you have your Series A round. And sometimes there's a post-pre-seed round in there somewhere, so maybe you have a fifth round. But there's a lot, sort of bifurcation of the rounds, focused on milestones, getting to that next level. But I think I would sort of summarize it by saying, perhaps sort of a bit of a healthy correction right now, but it's certainly not, come grinding to a halt.
All right, Cindy, you want to take that one?
Sure. I think we look at things just a little bit differently. At Illuminate, we are investors in enterprise technology. So really 100% SaaS companies, cloud-based companies, mobile software companies, but always with an enterprise focus, which can mean small and mid-sized businesses or large. It could be white collar or blue collar. But these are businesses that have very basic fundamentals to them, that they solve a business problem, that you can assess their success by their revenue growth, not by other metrics that are a little bit less tangible. And so I would say, we never were part of that crowd that was funding companies at extraordinary valuations. We've always been really concerned about the long term for these companies, because we know it takes 7 to 10 years to take an enterprise software company to a really successful exit, meaning exactly, the company we took public last year, I've been sitting on that board for 10 years. We invested when they had $100,000 of revenue, and today it's close to $100 million in recurring revenue. So fundamentally, I think also enterprise entrepreneurs tend to be a little bit more experienced. They tend to understand that they're going to have these multiple rounds of funding, and therefore putting an extraordinarily high valuation on the company at the beginning can actually do a lot more harm than good. It can be very dangerous to overprice a company and then have to go out and raise money and make it difficult to do so. So we're not changing our pace of investment at all. We've been investing throughout this process, but we've been really selective. We did 2 new investments last year. We'll probably do 3 this year. And I loved it when you said co-founder, because it makes us sound a lot bigger. But I literally was the founder of Illuminate, and have one other investing partner with me now. But it's an interesting world to be in, but again, I don't think it's quite as black and white as everyone else is feeling right now.
Nat,
Wow.
you're on.
So the world is awash in capital. Sadly, very little of it is precipitating down to venture capital. Most of it's going to mezzanine financing, buyouts, and things of that nature by a factor of 5 to 10, depending on what documents you look at. Also, I think that we have been the victim of really exorbitant pre-money valuations, and that has had a negative effect because the results of liquidities have not proved to validate the values that were being paid on the front end. That said, there's still plenty of venture capital around, and fully half the venture capital in the United States is in California, and probably 2/3 or more of that is in the San Francisco Bay Area. So you're in good shape if you're looking for money. What you need to do is you need to understand that you need to provide the venture capitalist with a story that is credible with respect to your team, with respect to the product, ideally with respect to the growth of the company by virtue of the number of people who, by eyeballs in the old terminology from the 90s, or by virtue of growth in transactions. And if you can do that, you can get money. If you don't have either of those and you're an early stage startup, then you need to be very persuasive indeed. You need to be able to prove to the venture capitalist that there is nothing in your life or your existence that is more important than the success of your company. When you go to sleep at night, when you wake up in the morning, and in your dreams, that company is at the front of everything. And if you can persuade the venture capitalist that that's the case, and you can somehow intrigue the venture capitalist into believing that that's a good idea, then in fact, money is indeed available. Seed stage money is now a little bit better because of crowdfunding, I think. It used to be just friends and family, and now there are other sources for very early stage money. And you need to get that money, and then you need to demonstrate for your A round that the idea that you've had is gaining traction in the marketplace. If you can do that, there's venture capital available to you.
Okay, so Nat, on that note, so say a company does get money. Let's talk about the round size. If money is shrinking up, does that mean that companies are not getting as much money, or they're getting more to try and last longer and have a longer runway?
That's a question with sufficient generality that I'm not sure that I can really answer it. So if you're a seed stage company, I think there are seed stage rounds still available. I mean, we at Claremont Creek, by the way, the first venture capital fund in the entire East Bay, not just Oakland.
Hummer Windblad, where are you located?
Oh, Hummerwood, but they left. They went to San Francisco.
That's still a
Where are you
number.
located?
Pardon me?
Where are you located?
In Oakland. You know, we're right there
Okay.
at City Hall. We're there, you know,
Okay.
It's beautiful.
along with, you know,
You're prodding
the
mayor.
Wall Street folks and Black Lives Matter.
You marching, huh?
Well, you know, I grew up in Berkeley in the 60s. It just feels like home. I'm sorry, where was the question? Seed stage?
Round size.
So
If they are
round
shrinking or
size, so we've
expanding.
done rounds as small as $250,000, and then we have continued, when we have successful companies that have proven that they got to the place where they said they were gonna get with that $250,000, we do our second rounds, an A round, we participate, we get our friends to come and invest with us, and then we do B rounds and C rounds and hopefully get the company all the way to liquidity. So I would guess that the answer to that question is it really completely depends on the needs of the company, the stage of the company, the stage of the development of the technology. We've found postdocs at the university still working in the laboratory and invested in them, and we have found companies that were quite considerably further along and invested in them, and so our round size has been probably in the low end 250,000 and on the high end 5 or 6 million in a first investment.
Wes, what are you saying? Are entrepreneurs taking less money and getting what they can, or raising more and longer runway?
I think it's actually a little bit of both. So this idea that there's been sort of this staging of the seed stage into maybe 3 or 4 different rounds. You know, the advice we always give to folks is, you know, if you're just starting your company, or maybe you've raised your 50K in friends and family, and you think you want to go raise $1 million, it's really hard to go from 0 to $1 million, you know, very quickly, especially if you're very early and don't have a lot of traction. So the advice we always give is, if you're using a convertible note, use the valuation cap as a way to, you know, do a smaller round at a lower valuation, so you can entice people to invest. You know, maybe you do a $350,000 round or a $500,000 round, essentially call it your pre-seed round, do a convertible note, you can price it at maybe a $3 million valuation cap, so you're really sort of rewarding those early investors to take a risk on you when you're really pre-traction and early. And then you build on that early success. You take that 350 or that 500 and you build into the kind of metrics you need to have, start to prove out that you've got some evidence of product market fit, and then you can go out and raise your $1 to $2 million seed round. And so we're seeing the smaller pre-seed rounds to get the traction to raise the larger seed rounds, and then we're seeing the highest quality companies that are raising those seed rounds, or you call it institutional seed or Series AA, they're all kind of synonymous. Oftentimes they're priced rounds, and we're seeing those rounds getting bigger and bigger. And what happens is they set out to raise $1 million, and then they oversubscribe, which is another kind of piece of advice that we oftentimes give folks. So rather than saying you're going to raise 1.5 and then having this long, you know, distance to go from 0 to 1.5, say you're raising 1, and then once you hit 1, you know, the flywheel starts. People get more and more interested. You get a couple of institutional seed investors in there before you know it. You know, we write a $400,000 check typically in that kind of round. And you get 2 of us in there, you're at 800, then you have some individual angels in there. Before you know it, you're at 1.3, 1.4, 1.5, and you kind of oversubscribe. So I think we're seeing potentially some larger, you know, institutional seed rounds that are built on from sort of that smaller pre-seed round.
Cindy, I've got a question for you.
Yeah.
Let's talk about lead investors. What is the most important factor that you consider when you're considering being a lead or not? And what can an entrepreneur do to kind of tip the scales?
Well, I think what you're really asking is, how do you get someone to write a term sheet? And, you know, we typically invest as a lead or co-lead, and so it doesn't take something different from an entrepreneur to get us to lead or co-lead, because that's our plan from day one. We have gone into rounds that other people have led, and we've done rounds where we were a smaller portion than half the round, but that's the exception, not the norm. What I would say is, you know, just maybe a little contrary, Wes, to what you're saying, you know, we're not big fans of the style of investment that's what I would call a party round or a club round, where you end up with 6, 8, 10, 12 investors in whatever that round is, and each one is writing a small check. Wes isn't talking about their group writing small checks, but when you have a bunch of other co-investors that might have written each of them 25, 50K, 100K check to get to that $1 million or $1.5 million round, I have, through my own experience, lived the world where I believe in this company, but the other investors never signed up and never had a plan to have reserves for anything beyond that original round of financing. And where the company needed some additional runway, let's say you wrote a check for in total $1.5 million, they needed another $250,000, $500,000, 6 months maybe of runway to get to a really good revenue run rate, and nobody else at the table was stepping up. So we don't do those kind of deals anymore, we walk away. And it's something for you to think about in terms of picking the kind of structure and the kind of investors you want. And don't get me wrong, I understand there may be times when to get it done, you have to structure things that way. But as a former founder and CEO and entrepreneur who had my company here based in Oakland, right across from Lake Merritt, I value the fact that I had 2 strong firms at the table, and when we needed extra runway, which we did, they were both willing to write checks. They had reserves, they had planned to all along. So getting us to lead is not an anomaly, it's what we do.
Ruben?
I have to agree with Cindy. We essentially do the same thing in terms of the type of businesses that we invest in. Business-to-business, software-based companies that have a very solid team of a founder who knows how to sell and a founder who knows how to build stuff. And in terms of leading, we always lead. And the size of our checks are smaller just because we want, and the reserves are bigger, just because we know that in the early stage, that's really when you need a very strong business development team. We have a very strong portfolio services team that can support the startups in the early stage to go to the to the $1 million, $2 million, $3 million run rate. So that's sort of in our nature. We were built like that. We lead or co-lead. So that's really not hard for us. If someone comes with that kind of fits our criteria, it's not hard for us to start lead a round. But we try to stay away from many players in that round because we just don't know the other players in the round potentially.
And we had talked a little bit about the role of corporates. Do you want to talk a little bit about their increasing role and what they're investing in and how you feel about investing alongside them?
So if I actually read this whole thing, I would probably be able to give you some statistics. This is the National Venture Capitalist Association Handbook. But let me give you some anecdotal information. I would say of the last 10 investments that we made at Claremont Creek, 8 of them have had corporate investors as either part of the seed round, even the seed round, believe it or not, corporate investors in the seed round, or in an A round along with us. So it's the growth and importance of corporate investors is huge. And I actually think that that's going to continue for a while. Mind you, you need to watch out for that too as entrepreneurs. Because the instant that the market goes south, which by the way with this presidential election could easily happen, you will lose those corporate investors because the CFO of the company is going to go, what are we spending money on? And that happened to us several times actually, where there were corporate investors who were participants with us, and then because of either marketplace circumstances or the company's particular circumstances, like changes of CEOs, they backed out. But that said, corporate investors are extremely important at the moment, and I actually think that if we have a continuingly good marketplace, which may happen, I would give it 20%, but if it continues to be good, then I think corporate investors will continue to be very, very important in the growth of companies and in participation.
Are you seeing in the seed round the corporate investors actually getting active and assisting with alliances or assisting with introductions to customers?
We certainly have.
That'll,
I mean, we have organizations like Cisco, USAA, Salesforce.com, Intel Capital, et cetera, as investors in our portfolio companies, and they can and will, but I completely agree with Nat. That could evaporate overnight.
Yeah, I have to say that of our co-investors at the seed round, there have been few and far between instances where significant introductions were made that resulted in business. But it was nice to have them on the letterhead. So
Well, in our case, they were direct customers.
already,
They were becoming direct customers and large direct customers
Yeah.
of these companies.
so it's
Yeah.
locked into the term contracts, their willingness to work.
Absolutely, absolutely.
Wes, are you seeing, what are you seeing as corporate involvement in your deals?
We're seeing some of it. I mean, we're seed to Series A and even, pre-seed to Series A, so we don't see as much the corporate activity at that stage. We've got Intel Capital has an offer on one of our companies for Series A, so I mean, we're seeing it in kind of the later stages. But I agree with all the cash on corporations' balance sheets right now. It's kind of good times for corporate investing.
Ruben, what are you seeing internationally?
Yeah, we see it. It's definitely there with the corporates here. We don't have that much experience with corporate here. We're not involved with any corporate. Internationally, mostly in the Caribbean, telecom companies, banks, software companies that are big, they like to get involved.
And are they providing value to their investments?
No.
Just to check.
So, companies like Cisco, they're making more money overseas, and they're not repatriating that money to the US. So are they setting up incubators and focusing on investing in Europe to keep the money there?
Well, we're working mostly in Latin America, and we're working with what they call Latin nationals, not multinationals. So they're not U.S. companies. They're actual Latin American companies or Caribbean companies that have large.
But like Cisco, Chile.
Cisco Chile does not get involved. Who gets involved is Microsoft. Microsoft gets involved, and they have this incubator called WIDA all over the world. So they're very active. But then you have Telefonica, which is a Spanish company, and they have their own funds, and they have their own incubators and accelerators all over Latin America. And then you have homegrown telecom companies in the Caribbean, like Lime. They put a lot of money into ecosystems and incubators, and they have their own fund. We're actually working with them on a fund in the Caribbean, but that's long term. But we don't see Apple, Google doing that type of stuff in Chile. Google is doing a lot of stuff, but mostly for ecosystem building, not really investing in the startups in the ecosystem.
And are the corporates seeing good liquidity or just a lot of paper gains?
In Latin America?
Latin America?
Just paper gains at this point. It's hard for international companies that are based outside of the U.S. to, and that's really the value that we provide, is how do we get them to exit in the U.S., not in Latin America.
So Cindy, we were talking a little bit about some of the inefficiencies of some of your portfolio companies and how they weren't invoicing annually, they were doing monthly. Across your portfolio companies and deals you're seeing, what are some of the largest inefficiencies that you're seeing?
Well, actually, our portfolio companies are invoicing annually. What I was saying is that a company we were considering an investment in was invoicing monthly, and I couldn't conceive of why they would do that in the enterprise space. Consumer products, yes, consumers are used to paying for something on their credit card every month, but there are outside of the Bay Area some of the really simple ways to conserve cash, to be more creative about how and when you need to finance your company are just not well known, which was surprising to me. And this was a company outside of the Bay Area that is doing $5 million in annual recurring revenue, and with most of their customers was charging them either monthly or quarterly. So that's just an astounding, inefficient way to manage your capital, because imagine how much more capital you have to raise and how much equity you have to give up to do that if you're collecting your cash quarterly or monthly rather than annually up front. Huge difference, and lots of people think of SaaS and think of it as, yes, it's a monthly subscription, but no, you don't collect the money monthly, not if you can possibly find any other way to do it. Other inefficiencies that we've seen, I guess I would say, there are people who still believe that you need to hire feet on the street sales reps to sell enterprise products of, let's say, over $50,000 in recurring revenue. Our portfolio companies have proven that's not the case. We have companies that are selling multi-$100,000 a year annual subscriptions with never having gone on site to the customer. And they're selling them using marketing automation tools, they're selling them using the internet and the web, and VoIP communications and everything else. And they're closing these deals. Sometimes they're even multi-year subscriptions. And literally, if there is any on-site visit, it's one visit, it's from the CEO, and that sales rep probably has never face-to-face until the annual user group meeting met their customer. And that is a huge cost differential. The feet on the street sales rep base comp is going to be $250K a year by the time, with even minimal compensation and upside. And these inside sales reps are, their base comp might be $40,000 to $60,000 a year with an upside maybe up to 100. So hugely different economics there.
And Wes, what are you seeing as some of the inefficiencies that can be improved upon both in companies and when they're raising money?
First of all, I know of a great company that does automated sales and marketing automation. You might be hearing from them later, I'm not sure. One of our biggest challenges lately is bookkeeping. Bookkeeping has been very frustrating for our startups, and it just keeps coming up again and again and again. It seems like a minor thing, but it actually is a major thing, and I'm a numbers guy, and when I get on the phone with our CEO, one of our CEOs, and she shows me the docs and says, hey, look, our revenue's up, big time. And I'm like, oh, this is like accrual revenue, right? She's like, yeah, I think it's accrual. And I'm like, well, what did your accountant say? And she's like, yeah, she said it was accrual. And then can I see like the details in Xero? So she sends it over, and I'm looking, and it's like revenue. It's charge, and it's collection from February, March, and June. I'm like, okay, so this is not accrual revenue. This is also collections on AR, and it's in the revenue number. So it's like it's boosting revenue by like 2 or 3x, and it's just stuff like that's really frustrating. And obviously at the seed stage, you're really focused on product and product market fit, but as soon as they start generating revenue, you want to have that nice up into the right curve of accruing revenue, especially for our SaaS companies. And so anyway, we struggle. I know there's a group here in the audience that we've talked to in the past, but we're still kind of struggling with figuring out like really good bookkeepers that are both really good attention to detail and cost effective.
Also what it depends on the industry too, because if you're talking startups that are in the ed tech world, you're selling to school districts or universities, your cycle, it would be great to get all the money up front, but you don't actually. You get purchase orders, and you have to, and that's where we play an additional role, is when you get purchase orders, you can finance those purchase orders, so you're not hitting your equity so hard. And that happens too in the ag tech, anyone in the agricultural space or food space, you will find that it kind of goes with the seasons. So the collection of money, it's always a negotiation. I agree with Cindy, it's a monthly, it's crazy, because it's just inefficient, your collections go crazy. And the third thing, in healthcare also, healthcare is, if you're in the healthcare space, so those are the three industries that we're in, long cycles of sales, long cycles of collections, purchase orders. So if you're in the SaaS space, software for those three industries is difficult to collect. But if you have purchase orders, so we always push our startups to.